George Pezzel, the Executive Director of the Transportation and Logistics Council. For over 46 years, the Council's been recognized for its educational programs and materials, and by our motto, Education for Transportation Professionals. I would be remiss if I didn't urge you to check out our website and the benefits of membership. The presentation you're about to participate in is an international trade policy. To put things in perspective, just think of this. The very clothes you wear, your computer, your smartphone, your TV, maybe even your office furniture or your car, and those fresh fruits and vegetables that you eat in February. Where did they come from and how did they get here? Even if you're not directly involved as an importer or exporter or part of an international supply chain, we're all affected by governmental policies and relationships with our trading partners around the world. I've had the privilege of knowing our presenter, Marianne Rowden, for about 30 years. Shortly after she graduated from Loyola University School of Law, Marianne joined our law firm in 1992, and she was promptly baptized into the world of transportation law and litigation very quickly. After a few years, she got one of those, offers you can't refuse, and she joined a prominent law firm in Chicago, where she became involved in international trade. In 2004, Marianne got an offer to join the American Association of Exporters and Importers in Washington, D.C., first as its general counsel, and later took over as the president and CEO. Marianne's been actively involved with international trade organizations like the World Customs Organization, Global Shippers Alliance, and with projects like the U.S. Free Trade Agreements. She's an adjunct professor at John Marshall School of Law. She speaks widely to U.S. and international audiences on trade issues and has been a frequent participant in the Transportation and Logistics Council's annual conferences. Please welcome Marianne Rowden.
Thank you so much, George. That was for that kind introduction. And I really feel that I would not be where I am today without my start at, the firm and with the council. So I thank you for that very much. What I'm going to do today is give you a presentation on what's happening right now. It'll be international trade oriented, but have some supply chain issues that you should pay attention to. And I call this the Great Decoupling, Trade Policy, Production Shifting, and COVID-19 Acceleration, because we're in the middle of some shifting trends. So with that, I will start my presentation. We'll do it for about 45 minutes, and then we'll get some questions in there. Okay. All right. So the topics that I'll cover are Trump trade policy. There are people who don't believe that the president has a trade policy. I'll talk a little bit about congressional cleanup because we're in a lame duck session of Congress, obviously. Production shifting and reshoring to the USA, and COVID-19 and the Great Acceleration. So what is the Trump trade policy? And if you really want to get a sense of that, the best thing to do is look at an article that the current U.S. Trade Representative wrote called How to Make Trade Work for Workers, charting a path between protectionism and globalism. And that's in Foreign Affairs magazine for July and August 2020. And the ambassador did talk about this during his testimony before House Ways and Means and Senate Finance Committee during the summer that he did for a couple of hours. And what's so striking about the Trump administration as a Republican administration in many ways was closer to the traditional Democratic positions on trade, that it really had to work for workers. And so whatever you think of Ambassador Lighthizer and President Trump, there is a method to their madness. And I just put in some bullet points of the basic head posts or guideposts in that article. And he talks about the limits of interdependence, right? Because during this COVID-19, we discovered how much China really makes that is critical to the US. So he made the point that some view trade through the lens of foreign policy, arguing that tariffs should be lowered or raised in order to achieve geopolitical goals. Okay, so that's one view of trade. Others view trade strictly through the lens of economic efficiency, contending that the sole objective of trade policy should be to maximize overall output. And you could call that, the Chicago School or the Milton Friedman School of Trade. But he says the right policy is one that makes it possible for most citizens, including those without college educations, to access the middle class through stable, well-paying jobs. Okay. So the Trump campaign and the administration came into office challenging the fundamental assumptions that we've had for the last 15 to 20 years on trade policy, and to balance those benefits between workers and capital, essentially. So that's what made this administration very different. And I think no matter what you think of the chaos that we've had the last couple of years, there was a political reasons and an intellectual reason for doing that. So I think what the president has tried to do is he understands leverage, but the way he used it was very different than what a normal politician would view as leverage, okay? So he used the size of our economy in bilateral negotiations because he understood that the size of our economy is diminished when we're in a multilateral setting, okay? And what was so unusual is that most politicians look at the trade deficit as a problem that they try to attack through increasing our exports. Whereas the president looked at our trade deficit specifically with China as leverage against China. And the best way to characterize that is an old phrase that I have up there. If you owe the bank thousands, a small amount, the bank owes you. If you owe the bank millions, you own the bank. And throughout Donald Trump's career, he's actually done that, where he was almost too big to fail as a client for many banks. We've been talking about intellectual property violations, forced labor, and foreign policy concern for a long time, but he really used them as a hammer. And what he did was blend import and export actions. So I'll talk about the OFAC sanctions a little bit. But he used all the tools, both on the import side and the export side, as a way to go after China. He also focused on big economies. So, for example, during the Bush administration, as part of the economic side of the global war on terrorism, we did free trade agreements with Oman, and other countries that really didn't make any sense because they have such small economies and not diversified economies. Where this president has concentrated on the big economies. So redoing NAFTA and USMCA with Canada and Mexico. Japan was the big one that was so hard for many years to get some kind of agreement. South Korea, we had also already had an agreement that he refined. China, obviously, European Union, United Kingdom, and Brazil. Okay, and the newest one is Kenya. Then he looked at a unilateral tariff reset and using what we call Section 301 duties. And these duties were used to deal with specific trade issues and increasing those duties, 25, sometimes 100%, to get a specific market access or removal of some non-tariff trade barrier or other issue. What is different about this president was the wholesale use of 301 tariffs across the board, particularly with China. And that was very different. So our average duty rate is about 2%. And obviously the Chinese, their duty rates are much higher. And that's part of the World Trade Organization negotiation on rates. And what we did is we lowered our rates as an incentive for other countries to lower theirs. And that never happened. And the president called out that disparity. The other thing that he has done is he is eliminating those carve-outs. of the trading system that subsidizes U.S. imports. So what do I mean by that? We've had a program for many years called the Generalized System of Preferences that allows least developed countries import goods duty-free into the United States. We look at it as an economic development, sort of like a trade for aid program. So if you think about it, back in the 60s, 50s and 60s, Ireland was on the Generalized System of Preferences. And then once their income or their GDP goes to a certain level, they are graduated from the program. This president has tried to really eliminate that program, or at least slim it down. So India is going after Thailand and also Turkey. Really tried to eliminate from the program. And the newest one that I'll talk about a little bit is eliminate exemption of de minimis shipments from Section 301 duties. Okay. So those are some of the things that he's done, so from a top line down to a bottom line. You know, I have the lists on here. You can't forget about the list. So those are big values in there. Two things to be conscious of is that, you know, we've have a system of product exclusions from these lists of the 25% duties. Those are going to expire pretty soon. So we're hoping to get them extended. And now there's litigation. Many people consider it a long shot. That is challenging the validity of the products on list 3 and 4A. So that court case is at the U.S. Court of International Trade. So if any of you want more information about that, I can send that to you. But if you're paying those duties, you know, you can file a lawsuit and let it sit there. We'll see what the Biden administration does. I think the court is waiting to see what the Biden administration does. All right, so let's talk a little bit about a congressional cleanup. You know, there's so many bills, so little time. This year was tough. We got USMCA passed, right? That was tough, but free trade agreements are always a heavy lift. And because of COVID and stuff, this was just a weird year. But there are a couple items that Congress, we are hoping really does get done. So that's the renewal of generalized system of preferences. Otherwise, that duty-free treatment goes away. So those expire if you have what we call a duty suspension. That expires December 31st. We have the miscellaneous tariff bill, which is somewhat similar to GSP. It's not country specific, it's product specific. And that also provides a duty suspension for a product, typically one that's not made in the United States. Usually it's an import product or item that is then incorporated into a finished item. And that's set to expire at the end of this year. And that's the problem with a lot of these trade programs have a sunset provision within them because they have to be authorized as they do impact the revenue of the United States. So the House has to take that up as a revenue measure first through House Ways and Means. And then, of course, with every free trade agreement that's big and complex, there's always mistakes and oops. So we have USMCA technical corrections. So the North American Development Bank repeal, you know, it omitted from the USMCA bill, MPF, you know, refunds. And then there's like foreign trade issues and foreign trade zone issues, and we didn't get drawback again. But so there's technical issues that have to be fixed. The sleeper issue that you should be aware of, and this is gaining traction in the waning days of this Congress, forced labor. We've already had one bill that passed regarding the Uyghurs, okay? So the Uyghur Human Rights Policy Act, okay? But there's another one winding its way, and you see these articles about certain companies like Coca-Cola, Nike, and Apple lobbying against this bill. And the problem that we have from a supply chain point of view is that Customs and Congress is looking at products, you know, through the supply chain, whether they were made with forced labor, particularly from the Xinjiang region of China. The problem with that is this is a production sourcing issue, not a supply chain issue, but we get stuck with the enforcement, if you will, of these human rights legislation. and has some real practical effects. So, I'm showing the regulatory actions that CBP has taken. So we have these WROs, withhold release orders on all cotton production from that region. We now have OFAC sanctions. So when we talk about sanctions, that's usually an export issue, right? Because you're sanctioning people in other countries or other regimes. Sanctions now have become an import issue because they want you to stop doing business with these companies that are operating in that region where they're holding the Uyghurs. And then we have a general notice. This was a surprise. I didn't think stevia came from Mongolia, but they have a general notice that they're going to stop shipments of stevia coming from Mongolia. And then many of your companies, if you're with a large company, may be getting from CBP what's called a forced labor risk analysis and survey assessment, or a RASA survey. And it's a questionnaire on forced labor in the production of cotton products. And now we see it with PPE, particularly textile masks. Okay, so be aware of that. For those of you who are involved in the logistics side, you're probably working with your trade compliance teams on these. So let's go to production shifting, because I think this was the goal all along for the president's trade policy, was to increase the cost of US importers, because they're the ones paying those 25% duties, not the Chinese, to change the calculation of the cost differential between production here in the United States and China. So I don't know if any of you go onto this site. It's called freightwaves.com, and it's almost like transportation TV. So it's kind of neat in that sense. But here are the issues. This is their slide, and they rank the number of industries that are starting to reshore back to the United States. So in less than a decade, we found that they found that 749,000 jobs came to the United States as a result of reshoring. Okay, so that's kind of interesting. And there are many people who always felt that those jobs would never come back. But again, it's a cost issue. We've got tax issues, and I'll go through some of those in the next couple slides. Okay, so this is sort of a two-step dance, if you will. There's one part of just getting out of China, as your single source country. And then there's the second step of whether to source back into the United States. So there are challenges whenever you look to move production. And we found this certainly with people who are looking to move out of China because they just couldn't take those 25% duties anymore. Other Asian countries, they may not have the production capacity. So let's take Vietnam, because China is so big. And I always think that modern China could not have been built without the United States, because no market would have been big enough to absorb all their exports. But when you compare that with a country like Vietnam, it is a fraction of the size of China, and it doesn't have the full production capability of China. Other countries may not have good logistics infrastructure, and you all will know this. India has probably lost a once in a history making opportunity. They're a big country. They could have the production capability of China. They have terrible logistics infrastructure. And most of the infrastructure in India was built by the private sector, not the public sector. And China, they had the advantage of building everything state of the art from scratch. So their logistics are first rate. Other countries may not have the technical expertise of that engineering class, of knowing technical standards, okay? And that's a big deal when you're exporting to the United States, whether it's Underwriters Laboratory or other standards for product safety and those other kind of things. And, the ultimate question obviously is moving production back to the United States competitive. Right? And so, everybody's going through this analysis of how do you review whether it is competitive to move back to the United States. And so I kind of look at it as and flip it on its head. What problems could moving production back to the USA solve for you? Are you moving to be closer to raw materials and other inputs? So if you're in the furniture business, perhaps you've got a lot of wood here in the United States. Moving production closer to the consumer market, the USA is still a very large consumer market. Are you looking to reduce pressure on profit margin by avoiding those 25% duties? And another big thing is increasing control over quality. I was sitting in a discussion group, a closed discussion group, and I almost fell off my chair. This is during the financial crisis. And one company, I think they were in the automotive industry, was moving production to India. And they were paying, they was shifting from paying somebody in the United States, let's say $12 or $15 an hour, to paying somebody 50 cents an hour. And the differential was so big that they could still absorb, the quality problems, because they knew that the quality would improve over time. So I almost fell off my chair when the company went through that. And the other thing that's interesting, and you will know this in the logistics industry, is does it simplify your manufacturing operations? Because the longer your supply chain is, the more complex it becomes. Okay, so that's how I help companies think about these issues. There are pros and cons, obviously, taxes is a big issue. Now, the Tax Reform Act did fix a lot of these issues. But there's location is another big issue. Although you do have a good variety of states that are business friendly in the United States, labor costs is a big issue. It's probably the biggest issue. And then suppliers. One of the things that's a problem with the whole manufacturing ecosystem, why it's so important, it's not only the skill set of the labor, and we have more automation today to deal with it, but do you have the other suppliers of raw materials and other inputs that you need locally? And that's a big issue. But there's no shortage of legislative incentives to bring back supply chain of certain key industries back to the United States. So medical supply, they definitely want it. Pharmaceuticals, they definitely want back. They also want the power grid, anything related to our power supply in the United States to be domestically produced. So let's talk a little bit about COVID-19 and what I call the Great Acceleration. Since 2008, there have been some trends setting in from the financial crisis. So in international trade, the traditional full container load ocean carrier freight has been flat, most of that time. E-commerce was growing 15 to 20% a year. And what I did is I served as the private sector co-chair on the World Customs Organization's e-commerce work group. So they were the first international body to try to come up with a framework of standards for processing e-commerce shipments. And we were looking at the cross-border movement of low-value physical goods. And digital trade is sort of heating up right now. When you, let's say, download a movie or even software, there's no customs duties assessed on that item if it crosses a digital border. There's a moratorium on that, but that's going to end soon. But that's a separate issue that the World Trade Organization is going to handle in its negotiations. But back in 2015, we were looking at that slow, steady increase in packages that many countries were dealing with, and customs services had to grapple with. And it took me a long time to figure out why e-commerce was so successful. Because back in the Obama administration, when we were negotiating TPP and TTIP, eBay and other e-commerce platforms were putting out policy papers talking about, globalization 3.0 and what they wanted out of those agreements. And I read them, I'm like, if they want, separate rules for them, they could just, take a hike. So it took me a long time to figure out why the e-commerce platforms became so successful. The Obama administration recognized to grow out of our financial hole, if they could get more than 1% of SMEs to export to another country, our balance of payments would improve. When I started looking at the public policy papers, such as the one produced by eBay, 81% of the smallest sellers on eBay's platform export to at least 5 foreign countries. That's phenomenal. The government can't even come close to that statistic. And it took me a long time to figure out why. And I finally figured out that when you order something online, unless you're a trade nerd like me, you're generally not going to be aware or look for where is that item made. So it's a transaction first and foremost, and it flips everything on its head. So you as a customer are searching for a particular item from a seller. You're not looking for a particular seller, you can compare sellers. So it's a transaction first between the buyer and the seller, and it's an import-export second. And that's all handled behind the scenes using the platforms. So what e-commerce does is it really flips the script on traditional international trade. Traditional international trade is your company that produces a product. You go out to access those foreign markets and look for customers. What e-commerce does is the complete opposite. It is a platform that is global by nature, and you as a seller just get on the platform and the customers come looking for you, okay? But for regulatory purposes, it flips the script as well, because if you're an importer of product, you're the importer of record, so you're responsible for all the regulatory compliance. In an e-commerce transaction, who causes the importation? Who becomes the importer of record? It really sort of eliminates it, usually the consumer, right? Who is, the exporter or foreign seller? It's, the seller. Are they the manufacturer? Maybe, maybe not, okay? Can any of these parties be responsible for the customs duties? The VAT, most other countries have a VAT, we do not. Marking of the government agency, licensing, permits, and regulatory compliance. And how does e-commerce affect security and safety, which is the supply chain side, right? And it's far less predictable, so you have a much more dispersed risk because you have irregular shipments. So e-commerce just does not fit the typical regulatory regime. So then we had COVID hit, all right? And so what we did at AAEI, obviously at the time we didn't know how long we were going to be home. We thought, the first 2 weeks, right? So what we did is we did a survey over a 3-week period. So we did it March 16th to the 20th. So that was week 1. March 23rd to the 27th, that was week 2. And then March 30th to April 3rd. And so we asked a series of questions, and you can see that snapshot over the 3 weeks. So these are the first 2 questions side by side. And we found obviously that the overwhelming majority through week 1 and then 100% weeks 2 and 3 of our members were affected by the virus. And then for most respondents, the biggest impact of COVID-19 affected American companies who had their supply chain in China. So that's when we really started to see our vulnerability. A distinctive feature of COVID-19 is that it prompted countries to impose both import and export restrictions. We really had never seen that before. We had different things along the way, like Fukushima, event, or a natural disaster like the tsunami and stuff like that. But we had never seen countries just send notices to the World Trade Organization saying, we're imposing export restrictions. And of all the countries that American companies source product, India was clearly the country identified the most as restricting the export of product. So there are certain active pharmaceutical ingredients or drugs that are produced in large quantities in India, and they were restricting them. Also, PPE equipment became a big issue. All right. So then we go to questions 5 and 6. And we're looking at, is your supply chain affected by export restrictions? But by countries not affected by COVID-19. So that was another thing. People used the virus as a way to impose restrictions. American companies reported taking a number of steps to reduce reliance on countries affected by COVID-19, most notably building up inventory of product and searching for product from other source countries. So, this has been very hard on trade compliance professionals, but also logistics professionals, because it was just a scramble for product. And building up inventory is not something we've done in many years. All right. So since the outbreak of COVID-19, have you faced losing major customers? So that was an increased possibility for many companies. And since the outbreak, are you seeing a shift between modes of transportation? Okay, that's another big thing. So the air capacity plummeted, I think something like 80%, right? So people had to really shift modes of transportation, which is a big issue. Are you seeing a change in export and import shipments, right? Both, It took a couple weeks to shake out, but it became a bigger and bigger issue. And, building that inventory up had to be horrific, during those first couple months. And that's why we had shortages of things, So COVID-19 really became an accelerant of pre-existing trends that were already happening. Okay. So what I'm showing you now is statistics. The chart on the left is US statistics from, I believe, Census. It says tradingeconomics.com, but I think this comes from the Census Bureau. And you see going up and down, and then it just starts to plummet, US imports and exports. And the chart on the right is actually from the World Trade Organization for trade and services. So you see that red line of travel, and it was down 81%. Transport got hit as well. So where are we now? So we see the lines creeping up a little bit for U.S. Goods and trade services deficit, trade deficit. And this is as of September 2020. So that's the last month we had statistics. And then for the chart on the right, which is a WTO chart, you've got your trade index meter. But look at that black line, that world merchandise trade volume. It's still down dramatically, So these are literally off the charts statistics, Okay, so in combining both the impact, those pre-existing trends, right? COVID hitting, and now e-commerce, looking at e-commerce, the question is e-commerce driving the bus? And the e-commerce supply chains were the only ones that really stood up and was able to sustain this extended lockdown period. What would we do if we didn't have Amazon? right? They had that capacity in a way that other supply chains didn't for um, distribution of consumer goods, right? The e-commerce shipments, which are also under what we call the de minimis, so that's shipments under $800 per shipment per day, and we call those type 86 entry types. Okay, so they're based off the manifest and not a formal entry. Those type 86 entries exceeded the normal type 1 consumption entries in July of 2020 for the first time. Now, I always knew this was happening because I was seeing the numbers when I co-chaired the e-commerce work group at the WCO. And I said to US Customs, you're not going to be able to keep up with the volumes. But I thought that would happen in 5 years. It happened in July of 2020. Okay. So now CBP has to process a lot more individual small shipments than they had to previously when the predominance was multinational corporations with full container loads of the same product. Okay. The other thing that happened through the last couple of years at the WCO and the problem with having customs deal with these issues is that e-commerce is really an export platform, but customs is preoccupied with imports, right? So you're going to get a different result and different equities and concerns as a result. So now the latest part of the Trump administration is that as part of tightening up all of those, what they see as people outside the regular system, paying full duties plus the 301, and what they see as a subsidy of U.S. exports from exports from other countries. So they're trying to stop the subsidizing of imports. They look at that as a subsidy of other countries' exports. And if you're not taxing them, that's a subsidy. So what they're trying to do is impose Section 301 duties, those 25% ad valorem duties on products from China. And they're trying to do it through a Federal Register notice that they're trying to jam through at the last minute. And I didn't even know about it. Some Sharpie lawyer, I don't even look at the Office of Management and Budget website. I look at the semi-annual regulatory agenda that's in the Federal Register for every federal agency and department. And that's what I, use to track what I expect the Federal Register notices will be. This was not on the semi-annual regulatory agenda. And I think Pina Navarro is really the driving force of this. And they are trying to get it through without a cost-benefit analysis. Now, there's an executive order that says any Federal Register notice that will have an impact on the economy of $100 million or more has to have a cost-benefit analysis, and it gives you about 60 days to respond rather than the typical 30. So there was a Sharpie lawyer who was looking at the OMB website and discovered this and said, oh no, this is not good. This is not good. And so we put together a coalition, and we have a number of trade associations talking directly to OMB. And that's fairly unusual. OMB is really like the traffic cop for all federal agencies in approving and reviewing Federal Register notices or notices before they appear in the Federal Register. And they really, it's internal to the government. But you can make an appeal to them, and that's what we did. And it was very strange because they say, we want to hear what you have to say. We can't respond, but don't think we're not taking your issues into consideration. And it was really the small business, and it's an interagency team. So you have Customs on there, you have Treasury on there, small business, you have Commerce on there. And it was the small business advocate who said, what's the impact for small businesses? So the Express Association already put together their numbers and this will affect 120,000 shipments a day. And I scrambled together and put together numbers. And I think my numbers are very conservative. I said, I think there's 12 million sellers using e-commerce platforms. 4.6 are SMEs, the vast majority of them, but I was being conservative. And so I just did quick calculations, and you get over $100 million really fast. So, you know, what I've learned over the years that I wish I learned earlier in my career is I have a fancy law degree, which I use to draw simplified pictures of trade and transportation for policymakers. And that's what this represents, how you break it down of how we get over that $100 million really quickly. So you got the consumer in the US orders an item that's valued at $65, right, from an online retailer. And the e-commerce companies orders that product and maybe it's $50, right? So the declared value is $50 when it comes into the United States. But then they get a bill for $110 from their broker. Okay, so this is how we break it down, right? You've got the cost of the item, and so it's a $50 item, and then you add on to the Section 301 duties of 25%, you got $12.50. The regular duty on top of that, let's say it's 2%, which is our average duty rate, so it's another $1. Then you have that merchandising processing fee, which pays for automation and, you know, other things that customs does. So you're looking at another $40. And then you add just the broker fee of $20 to file the entry, right? And that's pretty low. And then you add another $20 onto that. So that's what we came up with. It's back of the envelope calculations. You know, you do it for one item, one shipment, or one product that's moderately priced, and you come up with, $110 in cost for an item that is fairly nominal, but you multiply that by 4.6 million, and that's just one transaction. That's not multiple transactions. So you get to $279 million pretty quickly, and we say this is going to cost billions of dollars. So that's where we are now. They haven't been able to get this through, so we have appealed to Congress. We're asking them to write a letter to OMB saying this needs a cost-benefit analysis. There are limited options that we have. We may have to go to litigation and seek injunctive relief, because unlike a normal company that you guys work for, multinational corporations, at least for a period of time, can withstand those 25% duties. It kills their cash flow and stuff, but the company is not going to go bankrupt right away. For e-commerce companies, it totally changes the cost structure for them, and it'll knock them right out of the game. So that's why this is a real problem, and it's shifting how we as Americans do international trade. So I just wanted to show you the trends of what's happening, where we are, and literally show you how global trade is changing before our very eyes, and how COVID-19 is actually accelerating that shift. And I'll stop there and be happy to answer any questions you may have.
Currently, Marianne, we do not have any questions that were submitted via the Q&A. So we'll wait a minute to see if any questions do come up here.
One of the comments that I'll just make, because many of you may be multinational, some of you may be in other, SMEs, different size companies. I think this year, this was happening 2 years ago, we called it omni-channel, at least for retailers. And what we learned is that many retailers said, we have to be in multiple channels because that's dictated by the customer. Some customers want to come to the store and feel the goods. Other customers will come in, but then order online. So if you're a retailer or have any consumer facing business, you have to have these multiple channels to get goods to people. And I think logistics professionals, this is, I'm sure, has been a big challenge for many of you, how you integrate this into your legacy transportation systems and supply chain, because it's a totally different animal, and it is not easy. But it's something that is growing, and now with COVID, it's the wave of the future. Will we ever go back? So like when I left Long Island working for George, I went into Chicago and I gave up my car. My sister had gotten in a car accident, so I traded her car, and I got a couch. Okay, and I brought the couch out to Chicago, so I didn't have a car, but where I lived didn't have a lot of grocery stores. So I started, Peapod, back in 1998. I started using them, and I've never gone back. And I think that's going to happen for a lot of consumers. That even after the pandemic passes, I think we've changed permanently how people shop for their consumable goods.
At this point, I'm going to ask Katie Warner from the Transportation and Logistics Council to say a couple of words. And as Katie and then Brent are speaking, this is the opportunity, and I will promote, so to speak, everyone to a panelist that chooses to stick around for the social hour. And just a reminder, when I do that, it automatically takes you out of the meeting, but then automatically brings you back in. So at this point, take it away, Katie.
Okay, hi everybody. I'm Katie Werner, aka Diane Smid. Since we job share, we mostly see emails coming from Diane, but it's usually me. Here at headquarters, I'm in charge of membership and helping out with our seminars and our conference. So today I just wanted to mention a few things about membership. I know we had a good mix of members and non-members attending today. Non-members, I would encourage you to check out our website at tlcouncil.org and consider joining, because one of the benefits of membership is member pricing to our educational programs, such as these virtual workshops. Starting next year, there will be a fee for non-members to attend, and members will remain free. So to encourage you non-members to join the council, I'm going to send you an email, me from Diane, with a special membership offer. So please be on the lookout for that. And thank you for today, Marianne, and thank you all for attending.